Hello guys, welcome to lesson 9 of the course. On today's lesson, we're going to be talking about false flags, false breakouts, and the AMD model. Just so you're aware, if you hear any thunder noise in the background, I'm currently in an Airbnb right now, and I'm by the balcony, and you might probably hear some noises. So it is raining currently, and there might be lightning. So you might hear that in the background, and I do apologize for that. But I think this is a very good environment for me to do some lessons, so that's why I'm doing one today. Okay, so we're gonna go into the concepts first. As always, we're gonna define what our concepts are in this lesson, and then we're gonna go into examples, and we're gonna use examples to demonstrate the concept of price delivery. And we're going to start off with the false flags. Okay, so as usual, we pull up a blank chart and we use that for our lesson today. So I'm going to go with New Zealand dollar, and we're going to use daily chart, obviously, and we're going to get rid of all the annotations in the chart so we can have a very clean slate. Alright, so today's topic is going to be false flags. That's the topic for today. And let me just make the font a little bit larger. And there we go. False flags. Alright, so what are false flags? Obviously, you guys might be familiar with the conspiracy theories of false flags, with 9/11 and I think the war in Iraq. I think those are popular like false flags idea. And I'm not here to talk conspiracy theory, but whenever we talk false flags, I think people's mind automatically just go into those as a very good example. And if we look at the dictionary definition of what a false flag is, so I'm gonna Google it right now. Dictionary definition of false flags. Alright, so dictionary definition of false flag states that it is a deliberate misrepresentation of someone's affiliation or motives, something used deliberately to misrepresent in this way. So false flag, from I think it is Oxford Dictionary, 1569, from the year 1569, where the term false flag was coined from, states that it is something which is used to deliberately misrepresent something else. Okay, and that definition is literally what false flags are when it comes to our concept, institutional concept, in trading. Now, if you look at classic retail textbook, they teach about bullish flagpoles and bearish flagpoles, and if you don't know what flagpoles are, then consider yourself lucky. Okay, but for people like myself who've been exposed to retail trading before switching over to institutional trading, we know what false flags are. So let me just show you a crude example of what a false flag looks like. Okay, so again, it is a classic chart pattern where the market makes an impulsive move in one direction, and then the market starts to retrace and retrace and retrace and retrace, and then makes the second impulsive move in the direction of the first impulsive move. Because this is what the retail textbook calls false flag. So in this example, because the direction is bullish, this is going to be a bullish false flag. Like I said, that's a bullish false flag, and they call this the flag, and this is the pole. And because if you look at this, it looks like a flag. It looks like someone's waving a flag. So that's what I call this, a bullish flagpole. Okay, so this is a bullish flag in classic retail price action. And then obviously for a bearish flag, it's going to be your impulsive move starts on the downside, and then you have a retracement higher and higher and higher and higher and higher and higher, and then you have your second impulsive leg to downside, and this is the bearish flagpole, or this is the bearish flagpole, and this is the flag. Okay, so this is your bullish flag, and this is your bearish flag. So these are very rudimentary description of what classic retail flags are. You can go on Google and you can Google all of this, and you see this description there in Google, what flags look like in classic price action. And we could just go to any random chart and pull up pretty much examples of false flags. Okay, but what I'm teaching here is how they could be useful to you in the proper context, because the thing with retail ideas and retail concepts is there's a measure of truth to them. It's not that we just ignore our retail concept, because if we go on ahead in this module, I'm going to teach you about false head and shoulders. And me teaching about false head and shoulders does not necessarily mean that you cannot use head and shoulders to be profitable. You only have to use them in the right context. Okay, so now the theme with retail, which is what I'm trying to draw your attention away from, or I'm trying to teach you to not follow, is that they view the market in terms of patterns. Okay, they're not understanding the underlying reasoning why the market should deliver the way it should deliver. They're only looking at patterns. So the market has done this in the past, so it is most likely to do this in the future, so that becomes my model. And there's no reasoning for context. Context is what gives validity to all retail concepts. I know when retail concepts are most likely to work. I also know when retail concepts are most likely to fail. Okay, because I'm applying context to them, and that's what allows me to understand the validity of that retail idea or not. Okay, so that does not mean you're gonna go on chart and see examples of bullish flags and bearish flags. You can obviously see examples of bullish flags and bearish flags, but you're going to spot them only in hindsight. It's going to be very difficult to trade them using foresight, because a lot of times they fail, and the reason why they fail is because a lot of individuals who are using the patterns are not using the patterns in the right context. Okay, so that's what we're trying to discuss today. So now with classic false flags, this is what they look like ideally, right? So the market makes an impulsive move in one direction, then the market starts to retrace, and then makes another impulsive move in the previous direction of the impulse price swing. Okay, same thing with the bearish false flag or bearish flag. Market makes one move on the downside, retraces back up, and then makes a continuation move lower. Now with the false flag here, a lot of times what the textbook don't show you is that you get something like this. Okay, that the market goes all the way back down to this leg that starts to move higher, and same thing goes for the bearish false flag. Market goes like this and runs all the way higher. Okay, now sometimes it could run a short-term high and then run deeper and clear out the low from the initial impulse price swing. Other times it can make a torso lower, not here, it can make a torso lower and then run the high from the initial impulse leg lower. Now the reason why I can do this sometimes is because by running below a short-term low in what retail considers a bearish flag, that they sell short at the breakout, because that's what the textbook teaches. The textbook teaches to either sell short at the breakout, okay, or sell short the retest to a trend line measured by taking all the lows in a bullish retracement in a bearish false flag, and you sell the retest to trend line. And what they teach is your take profit should be the measurement of the origin of the initial impulse leg to the terminus, and that's your ABCD range projection, and that's what your take profit should look like. That's what classic textbook teaches. And a lot of times you're going to see price will break out of that flagpole and just run the opposing direction. And what gives context to this is obviously it's just your order flow. Okay, so what is the order flow? Without understanding order flow and drawing liquidity, there's no validity to the flag concept from retail. So what I have here is an example of cable from 13th of March, which I think is 2 weeks ago. Okay, and what you can see here is what retail consider classic support, resistance turn support. Okay, so you have resistance turn support here. You also have resistance turn support here. So retail will look at this entire range as classic support. Now look at what's going on here. Isn't that the impulse swing higher? That's this. That's a bullish. That's the bullish leg of that flagpole. And then look at the retracement lower. So if you use a trend line like this, it looks more like a flag. Okay. Now watch what's going on here. Market trades down here, or you think everyone else is doing. The moment the market runs above the short MI, retail is going long. Okay, retail is going long because their idea of this price action is that we have a bullish flag at a level of support. Okay, resistance becomes support. If that's the idea of looking for a continuation higher, because usually what they're going to do is, again, the range measurement projections, they'll take the low to the eye and take it to the retracement, and that's your target, and their stops is going to be below the low that makes the initial leg higher. Okay, so when I was in IML, I used to learn all these different concepts from the educators on there. I think Lasaldo, and if you don't know what IML is, then that's a good thing also. Okay, but it was a educational company where I was learning classic price action and all these patterns, head and shoulders, trend lines, indicators. I was learning all of that from them. Okay, so you have your impulse leg higher, and the market trades back down into what classic retail consider as support, and they're going along there. Now remember, it's a false flag. Okay, so the algo has engineered this specific pattern in price because everyone thinks that it's going to continue higher. So what do you do here? Market breaks lower and trades lower again. You have a bearish order block here. Market displaces. You have a propulsion block there. Now the question is where you think price is going up or down into. Is price going higher or price is going lower? Obviously price is going lower for the sell stops because retail is going long at what they think is support. If they're going long at what they think is support, they're going to place your stops below the low that starts the original impulse leg higher, just like the textbook teaches. That's what the textbook teaches. That's how I used to trade 2017 going to early 2018. Right, I used to trade classic textbook price action. So what you can see here is once we broke higher above that short MI, you get a displacement. They get returned back into a breaker block, and then this is your propulsion block, and you can see the market runs for sell stops. So your entry will look something like this. Okay, you're selling at the propulsion block. The low of that propulsion block is your entry lower. Your stop is above the propulsion block, and your target is below the low that makes. This is just an idea. Okay, sometimes you could use a fair value gap to sell short. I think if we went into an even lower time frame, you can see very clearly what I'm describing. Okay, you have a steady decline lower going to an active session, which is the sort of London session, and then So let's define start of London session. That is London open. There, this candle starts London open. And then you have a run above a short-term high, okay, which convinces retail that we have a break out of the range, okay, and the market starts to go higher. So what are they doing? Just go along at the breakout, okay, and you're going along here again, and you're gonna have the stops below this. So if you went to a lower time frame, you can see that short is a fair value gap with a bear shoulder block and a breaker block. Short to my, we run above that. So you have a confluence of a breaker, bear shoulder block, fair value gap. This is your target around liquidity right there. If you miss the chance to sell short, you have another chance to sell short there as we return back up into the fair value gap along with a bear shoulder block. Last up candles, you can see the market distributes lower for sell stops. So this is an example of a false bullish flag or a bullish false flag. Okay, and then for a bearish false flag, just invert that for when the market looks like it wants to decline and drop lower after initial impulse leg lower, then retail is going to want to short that, and you can then look to go long against that. Now remember, not every time you're going to get a market break above a short-term high in the bullish flag. Now the way I like to trade bullish flags is I like to trade them as a TGIF type trade. Okay, they are my absolute favorite patterns to trade with TGIF. Okay, so meaning on Thursday going to Friday after we've seen the weekly range. Okay, when I'm counter trend trading, I like to see that. So we could go and look at just any random examples. I think it's the euro dollar. You're gonna see what I'm talking about. A lot of times you're going to see that very specific pattern as a TGIF type trade. And this is Monday, okay? This is Thursday, this is Friday. At the time of looking at this, okay, if we looked at this, doesn't this look like a bearish false flag? Sorry, a bearish flag. We have resistance there. We have our impulse price swing there. We have our flagpole here. Don't you think retail will look at that as a selling opportunity, especially when we return back into a level that they consider resistance? Remember, support, because we had to touch here and here and here. So that is retail resistance. You're looking to short that. If they're looking to short that, where are they going to put your protective buy stop as a form of protection against their sell orders? Okay, the stop is going to go inside the efficiency above the short-term high. So if we use a replay button, you're going to see the effects, and look at where the market reaches up into. Why do you think the market is aggressively reaching up into that? Because retail is shorting this. Okay, you can see how really straightforward this is. It's on all time frames. It's not just only on the lower time frames. Again, all the concepts being taught, they're all universal. What time of week does this come in at? This is Thursday and this is Friday. TGIF. They're my favorite patterns to trade. Or they're my favorite retail patterns to fade during the week on TGIF days. Okay? Friday, Thursday, Wednesday, Tuesday, Monday. Let's go again. Friday, Thursday, Wednesday, Tuesday, Monday. Sure, so Friday, we have another concept here. And that brings me to the next topic, which is, oh no. False breakouts. Okay, let's talk about false breakouts, and that would be a segue into the AMD model. What are false breakouts? In price, the market is only doing two things. The market is either trending or consolidating. Okay, these are the two states of delivery the market is always going to be in. The market is always going to either be expanding or it is going to be consolidating. Now, that expansion could be in form of a retracement or a reversal or a legit expansion in the direction of order flow, and then we have consolidation. Okay, so we have four basic market profiles. We have expansion, we have retracement, we have reversal, and then we have range bound or consolidation. Okay, now false breakout is dealing with one of the market profiles, which is consolidation. So in layman terms, consolidation essentially is when price is moving sideways, when the market is neither expanding higher or the market is expanding lower, but the market is just trading sideways. So let me show you conceptually, even though it sounds stupid, but this is what a consolidation looks like. Okay, the market is neither trading higher nor trading lower. The market is only trading sideways. Okay, so it's neither making higher highs or lower lows. It's trading sideways, and that's what a consolidation looks like. Okay, and this is where our false breakout comes into play, because what it textbook teaches is when you see price in the consolidation, you want to sell the breakout of the low of that consolidation, or you want to buy the breakout of the high of the consolidation. You want to put your stops on the opposite side of the consolidation. So again, I just went on a rant, so let me show you guys again what I mean there. So you have a classic consolidation. Market's making highs and lows, but it's neither making higher highs or lower lows. Sometimes it might drop lower, but it's always going to return back into the range. Okay, it's always going to return back in the range. Now, this is what the textbook teaches. In a consolidation, what you want to do is you want to sell the breakout of the consolidation. So if the breakout is a bullish breakout, then you want to buy long. So this is what they teach. Once you see this expansion out of consolidation, you buy the breakout, and your stop goes below the low of the consolidation, and your target is going to be a measurement of the range of the consolidation. So if this was the height of the consolidation from the low to the high, that's side of consolidation, then your target is going to be from the breakout of the consolidation to whatever the measurement is. That's your target, and your stop is going to go below the bottom of that consolidation. This is classic retail chart pattern, classic retail textbook trades or patterns. Now, how we utilize this information is we utilize what we call false breakouts. So usually what the algo would do is, again, it's all engineering liquidity. So if you go back to the lesson where I talked about engineering liquidity, this is how liquidity is engineered in consolidations. Now, that does not mean 100% of the time the market is going to obviously do this and then fake out. Okay, but majority of the time it will fake out traders. Okay, there are legit times where price will break out of consolidation and continue in that direction of the breakout and not be a fake out. The question now here is, what are those times where if we see a breakout in price, those are true breakouts? The answer to your question is depending on pre-existing order flow and the draw on liquidity. That's what contextualizes if a breakout is false or a true breakout. Okay, if you didn't have the context of draw on liquidity and order flow, then you miss the point entirely. Same goes for the concept I just talked about on false flags. Okay, there are times where those false flags, or the retail flag patterns are valid. Okay, because if you're never valid, then whatever on the textbook, because they work sometimes, but you need to know the context in which they work, and that's if it's in alignment with order flow and the journal liquidity, aka low resistance liquidity runs. Okay, so if we have a low resistance liquidity run down here, and we see this consolidation, when we see this breakout of the consolidation, that's a fake out, because retail will go and long that, and then we can fade the breakout. So we're acting like we're the institutions, because retail is going up there to go long, and institutions, you're selling short again retail long positions. Like I said, they're acting as counterpart of liquidity against retail buy orders or retail long positions. And then what happens next is the market fades that and runs lower and clears out sell stops, where retail protective stops would be resting at. And then institutions or a counterparty short here can then offset their positions against retail protective sell stops. And that's a profitable transaction for the institutions. That's the concept here. So you can see on Thursday going to Friday, on Friday going to Monday, what you have here, I think I actually made a mistake. Okay, this is going to Monday. So on the Friday going to Monday, what you have here is you have a consolidation on the 1 hour time frame. So if I use this for play tool and I went like this, okay, at the time of looking at this price action, if you're looking at this live, it looks so very, excuse me, it looks so very obviously bullish, right? Price is obviously bullish. We are in a consolidation. We have a breakout of consolidation, retested an old low. That's a short right there. That's a sell. That's what retail thinks. Okay, now I can go in and show you how we had divergence against dollar, and how at the time this was happening. Let me get rid of all of this price action. Okay, at the time that was happening, we're trading inside a bullish order block. That is a bullish order block there. That's the main threshold of that bullish order block there. Let me see what else is left. To the left. Awesome. All right. So we're inside a bullish order block. We have a consolidation price. Okay, this is our consolidation. And then we have a breakout of the consolidation. What do you think retail is doing? Retail is shorting the breakout, or they're shorting the retest to the low of the breakout, because that's what the textbook teaches. And then institutions, they're acting as counterparty liquidity to unwilling liquidity. Remember the lesson I did on the willing versus unwilling liquidity? I think that was an introduction to the course, where I talked about how there are lots of participants in the marketplace. They're on unwilling liquidity because they're not aware of the algo engineering liquidity. So they fall prey to the algo engineering liquidity, and then they become inadvertently counterparty liquidity to the institutions due to the algo engineering price. Okay, so what then happens next is you get displacement, break of a short term high, breaks a short term high. That's a buy right there. Okay, return back down into a bullshit block. You have displacement higher. You have return back down to a propulsion block. And then what propulsion blocks do, sends the market higher for all the buy stops resting up above here. Now, oftentimes we can even go all the way back up here to where we started the initial move lower. Okay, that's this. So where the origin of this move started from, we can even reprice all the way down there. So this, again, this is a bearish annotation or a bearish example, but just invert that for this, and that's a bullish example there. And so you have here a breaker block, fair value gap, And what you can see there is we traded slightly through the breaker block. Trades down there and expands for the buy stop up here, and clears out buy stop there, and even eventually clears out this side there. Okay, that's the run up into liquidity. And that's for false flag or false breakouts. Now the AMD model is just building upon that three-step process of the range or price engineering liquidity. Okay, so let me just type this out so you understand what I'm saying. We call this the AMD model. I'll make this a little bit smaller. Okay, that means accumulation, manipulation, distribution. Accumulation, manipulation, distribution. So inside the range, what's going on there? Remember, if you go back to earlier videos on the call of the course, I talked about range bound conditions being stable flows of liquidity. Okay, in range bound markets, orders are being built up in those market conditions, and that is accumulation. So it could be accumulation of long positions or it could be accumulation of short positions, but it's accumulation nonetheless. So we have accumulation going on inside the range, and then this is the manipulation phase. The false breakout of the range is manipulation to suck in liquidity, counter to the initial or intended liquidity. Okay, so the intended liquidity is on the downside. Now the market could easily, from the range, just break on the downside and run for which is the lowest in the current run. But because the institutions want to be a partaker of that distribution lower, the algo engineers liquidity by first up sucking up the market higher, which then induces retail longs. So this manipulation here, what it's doing is it is inducing retail longs. Again, the market is all being priced in terms of liquidity. So this here is inducing retail longs. Okay, that induces retail longs, and then by price trading out of that consolidation, what we've done there after we induce retail longs is where we've automatically induced protective retail sell stops. Okay, so if you're buying the breakout, your stop loss is a market execution to sell at a loss. That's a sell stop order. Okay, so retail longs being inches up there, and then sorry, not a sell stop order, that's a sell limit order, inducing protective retail sell limit orders, and then institutions here act as counterpart of liquidity. Institutions short into retail longs. Again, I want you to view this in terms of you're an institution. You're looking to gain liquidity from the participants in price. You understand how markets being engineered for efficiency to allow you get into moves and facilitate transactions. Okay, so if you wanted to short, you need a counterpart of liquidity for a transaction. So the algo is going to provide that to you by inducing liquidity into the marketplace. Okay, so this is induction of liquidity or engineering of liquidity. Engineering of liquidity in the sense that we're engineering liquidity on the sell side, and then we're inducing liquidity on the buy side, which then causes institutions to be counterparty to retail longs. And that's how you get your AMD model, which is accumulation, manipulation, and distribution. The range is your accumulation, the run higher is your manipulation, and then the true run lower is your distribution. That caps up the video for lesson 9, and I'll catch you guys all on lesson 10, where we're going to talk about trendline phantom. Trade safe.